Dividends are dead, and they are value destroyers rather than value builders. Buffett and Munger would agree that dividends are not the optimal way of cash distribution to shareholders. For decades, dividends were the unquestioned primary method of returning capital. Throughout most of the 20th century, especially prior to the 1980s and 1990s, companies paid out large fractions of their earnings as cash dividends, and investors evaluated stocks largely by their yield. The other alternative idea was for corporations to use this excess cash to repurchase their own shares. This was both rare and culturally discouraged. It was not until the late 20th century, and especially after the turn of the millennium, that share buybacks emerged as a dominant mechanism for distributing cash and reallocating capital. Today, buybacks often exceed dividends in total cash returned, and they have become one of the most important drivers of long-term shareholder returns. Yet they remain one of the most misunderstood tools in finance. This misunderstanding persists despite Warren Buffett advocating for decades that buybacks, when executed intelligently, may be the most shareholder-friendly use of capital. The following chart shows the dividend yield in gray versus the buyback yield in green for each of the 11 sectors of the S&P 500. The source is J.P. Morgan. The total shareholder yield is the sum of both the buyback and dividend yields. If the buyback yield is negative, this means that the companies in the real estate sector, for example, as whole have issued more shares than what they have purchased for the period of 2025. Share issuance is value destructive most of the time. Before you see the power of this new mechanism, you must understand why buybacks are a modern phenomenon. Before the 1980s, the regulatory environment was less friendly to buybacks, and companies were culturally inclined toward dividends. Share repurchases were viewed suspiciously, sometimes equated with manipulation, and lacked the structural acceptance they enjoy today. A few key developments changed that: Regulation Fair Disclosure, Reg FD, and modernization of SEC Rule 10b-18 provided a safe harbor for repurchases. The emergence of equity-based compensation created demand for buybacks to offset dilution. This happens when employees in a company are rewarded with shares. Investors increasingly recognize that dividends are tax inefficient compared to capital gains. The market rewarded companies that reinvested surplus cash into undervalued shares. This shift laid the foundation for Buffett's philosophy to take center stage. His philosophy stated that buybacks are wonderful when done at the right price. Warren Buffett has always viewed buybacks as a powerful mechanism for increasing long-term intrinsic value, but only when repurchases are executed below intrinsic value. His core framework can be summarized in a single sentence from multiple Berkshire letters. Buybacks should only occur when a company's stock is selling at a price below its intrinsic value. To Buffett, repurchasing shares is no different from acquiring a company. The return on investment must exceed the value paid. When a business buys back shares at attractive prices, each remaining shareholder owns more of the business. If a stock had 10 shares and you owned one of those 10, this is a 10% ownership. If a stock has 8 shares and you still owned one, this is an ownership of 12.5%. When buybacks occur, EPS increases even if net income is flat, as the share count goes down. Intrinsic value per share rises. Capital is allocated efficiently instead of wasted. Buffett often contrasted this with overvalued buybacks executed simply to boost short-term metrics or support stock-based compensation. Those are destructive, not accretive, but when buybacks are done sensibly, Buffett views them as the highest form of shareholder return. Why Buffett avoids dividends but buys back stock? Buffett has long argued that it is not Berkshire's role to force taxable distributions onto shareholders. Dividends generate immediate tax liabilities, while buybacks allow investors to defer taxes indefinitely. Dividends are taxed today. Buybacks do not get taxed until the investor sells. Many investors never sell, meaning an effectively untaxed position. Buffett himself is Berkshire's largest shareholder, meaning a dividend would trigger a massive personal tax bill. But more importantly, he believes capital should remain inside Berkshire as long as Berkshire can reinvest it at attractive returns. Once no high return opportunities remain, buying back stock at reasonable prices becomes the next most rational action. Buffett's rule is clear. If Berkshire can earn more than $1 of value per dollar retained, it should reinvest. If not, and the stock trades below intrinsic value, buybacks create more value per share than dividends ever could. This explains why Buffett repurchased tens of billions of Berkshire shares in recent years once the stock traded below his comfort price to value threshold, and why Berkshire still has never paid a dividend. An important dynamic to understand is how buybacks increase EPS even without earnings growth. One of the most misunderstood effects of buybacks is how dramatically they can increase earnings per share, even when net income is stagnant. Consider a company that earns $1 billion annually and has 100 million shares outstanding. EPS equals $10. If the company uses cash to repurchase 40% of its shares over a decade without increasing net income, its outstanding shares drop to 60 million. New EPS equals $1 billion divided by 60 million equals $16.67. EPS has grown 67%, even though net income has not increased at all. This is not financial engineering, it is mathematics. Each remaining shareholder owns a larger portion of the business. Buffett has repeatedly explained that buybacks are economically equivalent to increasing ownership in a profitable private company. AutoZone and AutoNation are the poster children of EPS-driven buyback compounding. Monish Pabrai calls these kinds of companies cannibal stocks as they eat away their share count base. Perhaps the most extreme example is AutoZone, which has repurchased more than 90% of its shares since the late 1990s. During most of this period, earnings grew at solid, but not hyper-growth rates. Yet the stock increased over 100-fold. Why? Because the share count collapsed. Each dollar of net income was divided among far fewer shares. EPS compounded at extraordinary rates, far faster than net income. Investors applied a stable valuation multiple to an accelerating EPS line. AutoZone proves a key principle. EPS growth can dramatically exceed net income growth when buybacks are aggressive and long-lasting. AutoNation is another striking case. It spent years buying back stock at valuations between 6 to 12 times earnings. While the auto retail business is not high growth, the company reduced its share count so aggressively that EPS compounded at double-digit rates, far above net income growth. This strategic repurchasing created a long period of strong shareholder returns, even though the core business was stable rather than explosive. AutoNation demonstrates Buffett's point. Buybacks can turn a mildly growing business into a high EPS compounding machine when executed below intrinsic value. Several years ago, economist Xavier Gabaek proposed one of the most fascinating modern theories regarding repurchases, that the stock market is inelastic, meaning changes in supply and demand have outsized effects on prices. In his research, he posits that for every $1 corporations spend on buybacks, aggregate stock prices may rise by $5. Why? Because passive index funds do not actively trade. Active managers have limited capital flexibility. Investor flows are relatively rigid. Thus, when companies collectively reduce share supply, prices rise more than proportionally. If Gabaek is correct, even partially, buybacks are not only EPS accretive but market price accretive, creating a powerful price tailwind independent of earnings growth. Buffett has never explicitly cited Gabaek, but his intuition aligns with it. Reducing share supply when price is below value benefits shareholders significantly more than dividends ever could. This is why he says, when the price is right, repurchases are by far the best use of capital. Share buybacks have evolved from a fringe practice to a central pillar of shareholder returns. Guided by Buffett's principle of repurchasing only below intrinsic value, buybacks can become one of the most powerful compounding mechanisms available to companies and investors alike. A business that repurchases wisely can generate extraordinary long-term wealth, even without spectacular earnings growth.